Your investment portfolio is probably hiding some serious risks, and you might not even realize it until it's way too late. I'm not talking about the big, flashy market crashes that make headlines. I'm talking about the silent killers, the portfolio sinkholes that build up quietly over time, right under your nose. They're ticking time bombs, just waiting to go off during the next round of economic chaos, and they could easily wipe out years of your hard-earned savings. But here's the good news. Today, we're going on a bomb disposal mission. I'm going to show you the 5 most common ticking time bombs I see in investors' accounts, and more importantly, I'll give you the exact, actionable steps to defuse each one before they get a chance to detonate. This isn't about scaring you out of the market. It's about empowering you to invest with confidence, knowing you've built a fortress around your financial future. Let's get into it. Section 1, Ticking Time Bomb Number 1, the Concentration Catastrophe. The first, and maybe the most seductive, time bomb is the concentration catastrophe. This is when you convince yourself you found, the one, that single stock or red-hot sector that's going to make you rich. We've all heard, don't put all your eggs in one basket, but in investing, that basket can look deceptively big. You might own 15, maybe 20 different stocks and think you're diversified. But if half of them are big tech companies, you're not diversified, you're dangerously concentrated. This risk often builds up as a result of your own success. We've seen it for years with megacap tech stocks. They outperform, their value swells, and they start to dominate your portfolio. It feels great, right? Your account balance is climbing, and you feel like an investment genius. But what's really happening is your portfolio's fate is becoming tied to a tiny slice of the market. And don't think you're safe just because you own S&P 500 index funds. A handful of tech giants make up such a massive piece of the index now that even passive investors are making a huge, concentrated bet without realizing it. Some analyses show that depending on how you define it, the true technology exposure in the S&P 500 can be over 40%, way higher than most people think. The danger here is that markets move in cycles. The sector that leads the market for one decade rarely leads it for the next. When the tide turns, whether it's due to new regulations, a shift in consumer behavior, or just a plain old correction, your whole portfolio is in the crosshairs. The same stocks that went up together will go down together, often with terrifying speed. We saw this play out with devastating effect during the dot-com bust in 2000, when the tech index lost over 70% of its value, wiping out fortunes that seemed untouchable just months earlier. A similar correction in today's top-heavy market could easily erase 20 to 40% from a seemingly diversified portfolio. So, how do you defuse this bomb? With true, deliberate diversification. This isn't just a buzzword, it's the foundation of smart risk management. True diversification is about more than just owning a lot of stocks. It's about owning different kinds of assets that don't all move in the same direction at once. Here's your diffusion toolkit. First, spread your investments across asset classes that have low correlation. The classic example is stocks and bonds. Historically, when stocks have tanked during economic stress, high-quality government bonds have often held their ground or even gone up, acting like a stabilizer for your portfolio. Second, diversify within your stocks. Don't just own U.S. stocks. Allocate a portion to international stocks to protect yourself if the U.S. market hits a rough patch. And just as importantly, make sure you own a mix of cyclical stocks, which do well when the economy is strong, and defensive stocks. Defensive sectors include things like healthcare, consumer staples, and utilities. People still need to buy toothpaste, get medicine, and keep the lights on no matter what the economy is doing, which gives these companies very stable demand. Third, think about adding a slice of alternatives, maybe 10 to 15% of your portfolio. This could be real estate through REITs or commodities like gold. Gold, for example, often acts as a safe haven that investors run to when they're scared, which can help insulate your portfolio against market shocks. For most people, the simplest way to do all this is with low-cost, broad market index funds and ETFs. A good, resilient starting point could be something like 60% in stocks, 35% in bonds, and 5% in cash. Just make sure that 60% in stocks is split between US and international markets, and across different sectors, not just today's market darlings. Section 2, Ticking Time Bomb Number 2, the Liquidity Trap. The second ticking time bomb is the liquidity trap. This is what happens when you have every last dollar invested, with little or no cash on the side. On the surface, this feels like the smart move. You hear that cash is trash because inflation eats away at its value. While that's true for your long-term money, having zero cash is a catastrophic mistake. It's like driving a car without a brake pedal and just hoping you never need to stop suddenly. So when does this bomb go off? When life does what it always does, it happens. The market takes a sudden 20% nosedive, and right then, you lose your job, your furnace breaks, or you get hit with a surprise medical bill. With no cash reserves, you're forced to sell your investments to cover those costs. And because it's happening during a downturn, you're selling your best assets at the worst possible time, locking in what could have been a temporary loss and making it painfully permanent. But it's a double-edged sword. A lack of cash doesn't just force you to sell at the worst time, it also stops you from buying. Market downturns, as scary as they are when fortunes are made. It's when fantastic companies go on sale. Without a cash reserve, what I call an opportunity fund, you're stuck on the sidelines, watching all the bargains pass you by. You can't buy low if you have no cash to do it with. Defusing this one is simple: build and maintain a cash reserve. Most financial advisors suggest having 3 to 12 months worth of essential living expenses set aside. A common goal is to keep about 5 to 10% of your total portfolio value in cash or cash equivalents. Think of this cash as having 3 jobs. First, it's your emergency fund. It's the buffer that protects your long-term investments from life's curveballs. It's what lets you sleep at night. Second, it's your opportunity fund. This is your dry powder you can use when the market gets ugly and valuations look attractive. It lets you be greedy when others are fearful, turning a crisis into an advantage. Third, it's a volatility dampener. Just knowing that cash is there has a huge psychological benefit. It helps you stay calm during a correction and stick to your long-term plan. Where should you keep this cash? Not in a checking account earning zero. You want it safe and liquid, but also working for you a bit. High-yield savings accounts, money market funds, or short-term T-bills are great options. They offer competitive rates to help fight off inflation, while making sure your money is there right when you need it. This cash isn't dead money, it's the most flexible and defensive tool you have. Alright, we're about to jump into our third ticking time bomb, which is one of the most misunderstood risks out there. If you're finding this valuable and you want to keep building a smarter, stronger portfolio, do me a favor and hit that subscribe button and turn on notifications. My whole goal here is to give you the strategies you need to build wealth safely, not just react to chaos. And let me know in the comments, which of these first 2 bombs, concentration or the liquidity trap, are you most worried about in your own portfolio? I really do read all the comments. Section 3, Ticking Time Bomb Number 3, the set it and forget it myth. This brings us to our third time bomb, the set it and forget it myth, also known as portfolio drift. This one is sneaky because it actually starts with you doing everything right. You built a diversified portfolio, maybe that 60-40 stock and bond mix we just talked about. You set it up, and then you walked away, thinking the job was done. Here's the problem: your portfolio doesn't stay put. As the market moves, it silently changes your allocation for you. Let's say we get a few great years in the stock market. That 60% you put in stocks has now grown to become 70% or even 80% of your portfolio. Your bonds, meanwhile, have shrunk to just 20%. Without making a single trade, your once balanced portfolio has drifted into a much more aggressive, stock-heavy position. You're now taking on way more risk than you originally intended. That's the ticking bomb. You think you're protected by your original plan, but in reality, your risk profile has been completely warped. So when the next bear market comes around, and it will, your portfolio is going to get hit much harder than you ever expected, leaving you wondering what went wrong. Your past success has made you vulnerable. One of the big reasons people let this happen is a psychological trap called the tax lock-in effect. Your winning stocks have huge unrealized gains, and you don't want to sell them and trim back because you don't want to pay the taxes. So you just hold on, letting that concentration risk build and build. The fix for this is a simple but powerful discipline: rebalancing. Rebalancing is just periodically checking your portfolio and making trades to bring your asset allocation back to its original targets. It's like routine maintenance on your car. It keeps things running smoothly and prevents small issues from turning into catastrophic failures. The fix for this is a simple but powerful discipline: rebalancing. Rebalancing is just periodically checking your portfolio and making trades to bring your asset allocation back to its original targets. It's like routine maintenance on your car. It keeps things running smoothly and prevents small issues from turning into catastrophic failures. The process itself is straightforward. You sell a bit of what has done well and is now overweight, and you use that money to buy more of what has underperformed and is now underweight. This is psychologically tough but mathematically powerful. It forces you to automatically do what every investor says they want to do: sell high and buy low. It's a built-in system for profiting from volatility instead of being a victim of it. And as a bonus, particularly in a taxable account, you can practice tax loss harvesting. When you're rebalancing, if any of your investments are down, you can sell them to realize that loss. You can then use that loss to cancel out capital gains from the winners you're selling, or even offset up to $3,000 of your regular income each year. That can lead to serious tax savings. A $10,000 loss used to offset gains could save you $2,400 in taxes if you're in the 24% bracket. That's a direct reward for disciplined management. Don't let your past winners become your future downfall. Schedule your rebalancing and stick to it. Section 4, Ticking Time Bomb Number 4, The Silent Killers, Inflation and Fees. Our fourth bomb is actually a pair of silent killers: inflation and fees. These risks don't go off with a big bang like a market crash. They're more like a slow, corrosive acid, silently eating away at your returns and destroying your purchasing power for decades. Let's start with inflation. It's the invisible tax on your money. You might be thrilled to see your portfolio grow by 7% in a year. But if inflation was 4% that same year, your real return, the actual increase in your buying power, was only 3%. Over time, that gap is devastating. An average inflation of 3% will chew up over a quarter of your money's purchasing power in just a decade. Your wealth is effectively shrinking. The second silent killer is fees. Investment fees, especially on actively managed mutual funds, might seem tiny: 1%, maybe 1.5% a year. But that small percentage is a time bomb for your wealth. Let me put this in perspective. Imagine you invest $100,000 for 30 years and get an 8% average annual return. If you pay 1.5% in fees, your portfolio grows to about $660,000. Not bad. But if you had used a low-cost index fund with a fee of just 0.1%, that same portfolio would have grown to over $950,000. That tiny difference cost you nearly $300,000. It's the single biggest factor you can actually control to boost your long-term results. Defusing these silent killers takes a two-pronged attack. First, to fight fees, you have to become a cost fanatic. The solution is to use low-cost index funds and ETFs for the core of your portfolio. These funds just track a market index, which gets rid of the high costs of active managers. You can buy a broad market ETF for an expense ratio as low as 0.03%, while most active funds charge 1% or more and still fail to beat the index over the long run, largely because of that fee drag. Second, to fight inflation, you need to build a portfolio that's designed to grow faster than prices. This is the main reason we own stocks. Their long-term growth is one of the best hedges against rising prices. You can also get more specific by including assets that do well during inflationary times. This includes real assets like real estate and commodities. Companies in sectors like consumer staples and healthcare also tend to have pricing power, meaning they can pass rising costs to customers, which protects their profits. Quality, dividend-growing stocks can also be a great inflation hedge, as that rising income stream helps you keep up. Don't let these silent killers sabotage your future. Be relentless about minimizing costs and make sure your portfolio is built for real, after-inflation growth. Section 5, Ticking Time Bomb Number 5, the Panic Button. We've made it to the fifth and final ticking time bomb. And this one is the most dangerous of all, because this bomb is you. It's the panic button. All the other risks, concentration, illiquidity, portfolio drift, fees, are external problems you can manage with a good process. But the panic button is an internal, emotional threat. It's that urge to throw your entire strategy out the window at the exact moment of maximum fear. You know the scenario. The market has been falling for weeks. Headlines are screaming about a recession or a financial crisis. Your portfolio is down 25%. Your stomach is in knots. You're checking your account balance obsessively, watching years of savings just evaporate. Every fiber of your being is yelling at you to get out. Sell everything, stop the bleeding, and run to the safety of cash. This feeling is driven by a powerful bias called loss aversion. The pain of a loss feels twice as bad as the pleasure of an equal gain. Hitting that panic button is the single most destructive financial decision you can make. By selling after a huge drop, you turn a temporary, on-paper loss into a permanent, catastrophic loss of capital. Even worse, you're now on the sidelines and will almost certainly miss the recovery. The market's best days often happen right after the absolute worst days. Missing just a handful of those best days will completely wreck your long-term returns. Trying to time the market is a fool's errand. It's a strategy that has been proven to fail again and again. So how do you stop yourself from hitting the panic button? The answer is to create a system before the storm hits, a system that separates your emotions from your decisions. The best tool for this is a written investment policy statement, or IPS. Think of it as your personal financial constitution. You write this document for yourself when you're calm and rational. In it, you define your financial goals, your time horizon, your actual tolerance for risk, and your target asset allocation. Most importantly, you write down your rules of engagement. You decide, in advance, exactly when you will buy or sell. For example, your IPS might say, I will rebalance my portfolio once a year on my birthday, or I will not sell any of my core stock holdings unless my life goals fundamentally change. This document becomes your anchor in a storm. When the market is crashing and your emotions are running wild, you don't have to guess what to do. Your only job is to follow the plan that your calm, rational self already made for you. It replaces emotional guesswork with cold, hard discipline. Your biggest enemy in investing is usually the person in the mirror. An IPS is your shield against that enemy. So there you have it, the 5 ticking time bombs most likely hiding in your portfolio. The concentration catastrophe, the liquidity trap, the set it and forget it myth, the silent killers of inflation and fees, and finally, the most dangerous of all, the panic button in your own head. Look, the point of this wasn't to scare you, it was to arm you with knowledge. Because once you can see these risks, you can control them. Building a truly resilient portfolio isn't about predicting the future or finding the next hot stock. It's about having a durable process that can handle whatever the market throws at you, so you can stay in the game and let compounding work its magic. Now that you know how to spot these bombs, the next step is to find them in your own accounts. To help with that, I've put together a free, one-page, portfolio risk audit checklist that walks you through how to check your portfolio for each of these 5 risks. You can download it for free at the link in the description. It's the perfect first step to take right now to start defusing these bombs for good. Thanks for investing your time with me today. Be sure to subscribe for more videos on how to build wealth with confidence, and check out this next video on my screen about the 3 best defensive sectors to own for the next decade. Stay disciplined, and I'll see you in the next one.